March 2020. The world was shutting down. Markets were collapsing. Every headline screamed fear. Every portfolio turned red. And in those moments, millions of investors made the same decision. They sold. Not because the businesses had suddenly become worthless, not because their long-term plans had changed, but because their brains convinced them they were in danger. The strange truth is this: market crashes are not just financial events. They are psychological events. And while most investors panic, a small group of elite traders and hedge fund managers become calm. Because they understand something the crowd does not. They know that the greatest opportunities are often hidden inside the greatest fear. Today, we're exploring the psychology during market crashes, why intelligent people panic, why discipline disappears, and why some investors emerge stronger while others never recover. Most traders believe market crashes destroy portfolios, but that's only half the story. The bigger damage happens inside the mind. The market falls 10%. The investor's confidence falls 50%. The market falls 20%. The investor abandons the plan completely. The real enemy isn't volatility. The real enemy is emotional decision-making. Because during a crash, your brain stops behaving like an investor. It starts behaving like a survivor. And survivors don't think about opportunities. They think about escaping danger. This is why market crashes create a massive divide. One group reacts emotionally. The other responds strategically. One sells at the bottom. The other prepares for the recovery. And the difference begins inside the human brain.
Imagine you're walking through a forest thousands of years ago. You hear a sudden noise. Your brain instantly assumes danger. A predator might be nearby. You don't stop to analyze. You react. Your heart rate increases. Adrenaline floods your body. Your muscles prepare for action. This system helped humans survive. But there's a problem. Your brain cannot distinguish between a tiger chasing you and a stock portfolio collapsing. When markets crash, your brain activates the exact same survival mechanisms. The amygdala, the brain's alarm system, takes control. Stress hormones surge. Heart rate rises. Fear spreads through your body. Suddenly, the logical investment plan you created months ago disappears. Emotion becomes the decision maker. Think about the last time you watched a position drop rapidly. Were you making decisions, or were you simply trying to stop the pain? Behavioral economists discovered something fascinating. Humans experience losses much more intensely than gains. Losing 10,000 rupees hurts far more than gaining 10,000 rupees feels good. This principle is called loss aversion. And during market crashes, loss aversion becomes a weapon against investors. Every red candle creates emotional pain. Every portfolio decline feels personal. The investor starts thinking, what if it falls more? What if I lose everything? What if I never recover? Eventually, many investors sell, not because the investment is bad, but because they want relief. The sale doesn't solve the financial problem. It solves the emotional problem, at least temporarily, and that's exactly why panic selling happens. Investors sell to stop feeling bad, not because it's the best decision. The market doesn't force people to sell. Fear does. Now imagine experiencing that fear alone. It would be difficult, but manageable. Unfortunately, modern technology amplifies fear. Everywhere you look, someone is talking about the crash. Television broadcasts panic. Social media spreads panic. Trading apps send alerts. Financial influencers predict catastrophe. The result is a psychological feedback loop. Fear creates attention. Attention creates more fear. More fear creates more selling. More selling creates bigger headlines. The cycle continues. Behavioral scientists call this salience bias. The human brain pays extra attention to dramatic information, and nothing is more dramatic than a market crash. As fear dominates the news cycle, investors begin to believe the worst-case scenario is inevitable, even when the evidence doesn't support it. Humans are social creatures. When uncertainty appears, we look to others for guidance. This works well in everyday life, but in financial markets, it can be dangerous. During crashes, investors stop independent thinking. Instead, they follow the crowd. If everyone is selling, selling must be correct. Right? Not necessarily. History repeatedly shows that crowds often reach maximum fear near market bottoms. But when emotions dominate, logic disappears. The investor asks, "What are other people doing?" instead of, "What does my strategy say?" This phenomenon is called herding, and it transforms individual fear into collective panic. The crowd feels safest when moving together. Yet that is often when the greatest risks are being taken. What happens if the crash lasts months instead of days? This is where things become even more dangerous. Short-term fear becomes chronic stress, and chronic stress changes how the brain functions. Researchers studying traders discovered that high uncertainty causes dramatic increases in cortisol, the stress hormone. Over time, elevated cortisol affects memory, decision-making, risk assessment, and emotional stability. Traders become pessimistic. They remember previous failures more vividly. They lose confidence. They hesitate even when opportunities appear. This condition is often described as learned helplessness. After repeated losses, investors begin believing nothing they do will work, so they stop acting, even when conditions improve. Emotional hook, the crash may end. But many investors remain mentally trapped long after the market recovers. Let's imagine two investors. Both experience a 40% portfolio decline. Investor A watches financial news all day, checks prices every few minutes, feels anxious constantly. Eventually sells everything, locks in losses, misses the recovery. Investor B experiences the same fear, the same uncertainty, the same market conditions. But instead of reacting emotionally, he follows a predefined plan. He reduces position size, reviews risk, focuses on long-term probabilities, and remains disciplined. 3 years later, the difference between the two investors is enormous. Not because one was smarter, not because one had better information, but because one managed emotions better. Great investors understand a powerful truth. Market crashes distort perception. Fear makes assets appear more dangerous than they actually are. This is why legendary investors often become buyers during periods of panic. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This doesn't mean blindly buying every crash. It means recognizing that crowd psychology often creates mispricing. While the average investor asks, "How much am I losing today?" elite investors ask, "What opportunities is fear creating?" They focus on probabilities, not emotions, process, not headlines, long-term outcomes, not daily fluctuations. Emotional hook. The greatest fortunes in investing were rarely built during comfort. They were built during uncertainty. Fear is normal. Even professionals experience it. The goal isn't eliminating fear. The goal is preventing fear from controlling decisions. When volatility rises dramatically, reduce risk. Smaller positions reduce emotional pressure, and emotional stability improves decision quality. Your plan should be created before the crash, not during it. The market is not the place to invent strategy. It's the place to execute strategy. No one knows what happens tomorrow. Professional traders think in probabilities, not predictions. Ask yourself, will this matter in 3 years, 5 years, 10 years? A longer time horizon often transforms fear into perspective. The next time markets crash, do not make decisions immediately. Wait, breathe, review your plan, reduce risk if necessary. Avoid excessive news consumption. Avoid social media panic. Focus on data, not emotions. Remember, fear is information, but fear is not instruction. Your emotions can warn you. They should not control you. Every market crash tells the same story. Prices fall. Fear rises. The crowd panics. Discipline disappears. But eventually, the market recovers, and those who maintained emotional control are rewarded. The psychology of market crashes isn't really about finance. It's about human nature. It's about understanding how fear influences decisions, how discipline protects capital, and how emotional resilience becomes a competitive advantage. The market will always test your strategy, but more importantly, it will test your mind. Because in investing, the biggest battle is rarely against the market. It's against yourself. If you found this documentary valuable, remember, the market rewards those who can stay calm while others lose control. Subscribe for more trading psychology lessons from legendary traders. And until next time, protect your mind before you protect your money.